Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And welcome, Evan. Playing air drums over there. It's the Investor Coaching Show. Evan Barnard, myself, Paul Winkler here talking money and investing, and from our Relax About Money studio.
I know.
This is the first time you've been in our relaxed couches here.
I have to practice sitting up straight
This is
so
a
I don't
whole
look too sloppy.
Hey, that's why I got you those pillows. If you need more than one pillow, man, grab one. You ought to be just fine.
I'll figure it out.
Oh, man. So, I think we got some good stuff today. I think we have some really good stuff.
Man, there's
today.
always
It's gonna be
there's
fun.
been plenty in the news, that's for sure.
Yeah, you think?
I do.
You know,
I do.
OpenAI trying to beat SpaceX to the IPO. So we'll talk a little bit about that. One of those things, I was going to be on TV this week, and somehow the schedule got messed up. I don't even know what it was, but I had a bunch of stuff prepared. So we'll talk about it today instead. But that was one of the topics, was the IPO, and has some really good stuff on that. The other thing that I think is, well, I mean, gosh, you know, what's coming in the news that we just don't know about yet.
That's why they call it news.
Yeah, that's why we call it news. And how that affects stock markets can be anybody's guess. So that is... and you know, I had this thing, Evan, I was thinking about in terms of people, we have the basics of investing, so probably we'll get to this sometime today, is ETFs versus mutual funds, difference between these different investment vehicles, how they differ, how the various companies, how big of a difference there can be between companies that are investing in the same exact area of the stock market, but how big of a difference you can have in the returns over periods of time, and in the risk, and in the number of holdings in different types of investment vehicles. So I thought we'd talk a little bit about that as well.
Yeah.
Now, there's one thing that I thought I would start with today. I think this will be fun. I don't know how long this is going to go.
It's all right.
So
we got a couple hours, man.
We got some time. But this one was... I was watching this video, and I actually I enjoyed the premise, not necessarily the details, but the premise of this guy's video. And he was talking about financial planning, and he was going to try to pack everything he knew from 30 years. So apparently that's how long he's been doing. It's like what I'm trying to think of. How long have I been doing this? 37 years, something like that, and try to pack it into 20 minutes. I don't think so. But anyway, that was the premise of the video. Is like, we're going to pack all of this experience into a 20-minute video. And, you know, some of the things, the common questions that people have. You know, so I thought I would actually walk through some of these things and then give my own twist on it and expand on it pretty significantly and fill in some blanks I thought that he left out.
Yeah.
He started off with talking about retirement calculators.
Okay.
And the issue with retirement calculators, and he said that they lie. And I thought, well, that's kind of a weird way of saying it. A calculator lying,
right?
Or maybe just not necessarily being as helpful in giving you the information you need about retirement planning.
Yeah.
But you know, your 401ks, if you have a 401k with a major mutual fund company, and you've been on there, Evan, you know, where you have how much money are you going to have? How much income are you going to have based on your account balances?
Yes.
And the assumptions.
Yeah.
So kind of your thoughts on the ones that you've
look for the assumptions.
Well, yeah, you probably won't see them. No, that's a really good point, actually. You don't even see the assumptions.
Yeah.
You know, so you don't even know when they're telling you this is how much income you're going to have. But how has your experience been when it comes to these calculators and how reliable they are for the end investor?
Yeah,
and
it's hit or miss.
This is a 401k one, by the way. You know,
That's
so
okay.
big mutual fund companies.
Frankly, it's hit or miss. I think the issue becomes the difference in input on, use the term, an official financial plan or, looking at a forecast because that calculator has that participant's expected income and so forth.
Mm-hmm.
But that doesn't factor in, does his or her spouse work? And so that's going to affect their retirement. You know, I mean, there's a lot of stuff that's not in there. Some of the calculators I've seen include an estimate of Social Security in that number. And so you don't really know if that's coming from my bucket of money, $2,000 a month,
or if it's your actual Social Security benefit.
Total everything plus the bucket.
Oh, that's a really good point. That brings up something I hadn't even thought about. But when you're looking at Social Security, how it's calculated, it's based on 35 years of income.
Right.
And they are looking typically at your most recent income because that's all they have when they're doing that calculation in their calculator, and they may be way off.
Absolutely.
Yeah, so that's a really good point. I hadn't really thought about that.
And really the biggest issue for me thinking about that is you don't know it's off until you're 65.
And you retire. And you go, whoops, wait a minute. They said I could retire.
Right. You got to
Walmart, you guys hiring?
It in the bud.
The other thing that I find of it is that, the ones I've seen, it has used recent history as far as returns, and it continues to project out at that, and it may give you a false sense of security that you're going to have more money than you really are going to because they're using a shorter period of time.
Yep, totally.
And I've seen some that I think that the number is too low. I've seen a little bit of both.
Yeah. It's, they don't know. And a lot of this, the answer I think does boil down to the assumptions. They don't know you're going to work there till you're 62.
No, true.
They don't know.
True.
None of that factors in, say, merit stuff of, well, I'm going to be a division head and then I'm going to be a direct, significant changes in income and all of that.
Right.
But it's better than nothing.
Yeah, marginally. No, so the issue I have with the retirement calculators, and I've used them. I remember teaching a class on this stuff. Gosh, I think I taught my first class to financial advisors on this particular topic. I think it was like 27 years ago. That I did that. I remember being brought in to teach a roundtable discussion on that. And the issue I always had was the linear nature of the way they do calculations.
Yes.
So when you're talking about a linear calculation, you're saying, well, what if my return on my investment portfolio is expected to be 9% per year, just to use as an example. If my return is 9%, the next year is 9%, the next year is 9, it's 9, it's 9, it's 9, it's 9, on and on.
Right.
And then when I get to retirement, maybe I assume that it's going to be 5, 5, 5, 5, 5, 5. And, so the problem you're taking out of that is the risk, the volatility. And you can have very, very distinctly different amounts of money based on whether you have low returns early and high returns later. So if I have low returns in the first part of my accumulation for retirement, let's say that my average return is 10, but the way I get there, let's say my average annualized return is 10%, but the way I get there is negative 10%, negative 15%, and then 5%, and then, negative 3, and then 20, and then, then maybe 15, and then, it goes up from there. My average return may be 10 because, it was low returns followed by very, very high returns.
Yeah.
But if I'm putting money away for retirement, I'm buying more shares of stock or more shares of mutual funds, whatever I'm investing in, or ETFs. I'm buying more shares with that same amount of money. And then just before I retire, I own the greatest amount of shares. And then the market goes way up and I go, yippee, I did, my market timing is wonderful.
I've been bummed for 20 years, but now I'm happy.
Exactly. I'm assuming, and that's assuming you stay disciplined.
Yes.
During the bad years, right?
Yeah.
So that's one way. Or if I have really high returns, think, let's say 1990s, very high returns followed by a period of lackluster returns in the 2000s. So you could have that situation where it's, really great followed by not so great. Well, I kept buying at higher and higher prices in the 1990s if I'm putting money away on a regular basis. This happened to a lot of people.
Yes.
Where they got to 2000, 2001, the market comes down and then they have to go back to work.
Yeah. I think typically when we're looking at a portfolio, somebody comes in and we see their statement. they're heavily concentrated in large U.S. companies, and at that period of time, it was heavily concentrated in tech.
Almost always.
And I think the people that retired in 2000 fared worse than the people that retired even in 2008 or during COVID, because it was much shorter lived on a market basis. And, the people that retired in 2000 and got effectively a zero return on probably a significant piece of their assets for 10 years.
10, 12 years, sure.
Is devastating.
Yeah, absolutely. And that it hurt people an awful lot.
Yeah.
So that was number one. It's like poor assumptions in the way the calculators do things. They'll do a linear return. And the other thing is risk. They don't necessarily have, and this is what I always found, is I would have to tweak, I would have to look at the risk assumptions. And often when I'm looking at a calculator, the risk assumptions, they don't know how to measure risk, or they put the wrong number in for the risk measure, which is standard deviation. And it's garbage in, garbage out, is my point. If you don't know the level of volatility of a portfolio, if I don't know how much this could go up or go down in a given year, or what the range of returns would be at a 68, 95, or 99% confidence level, which is by definition, those of you that took a stats class in the past 20 years may remember that's how it works. You got to look at the confidence levels, and that's what that is 68 is your one standard deviation, 95 is 2, and 99 is 3. So you're going, well, if I don't know how big of a variance I might have in my return, I can't tell whether this is going to be successful based on the level of income I'm taking out. If, the market goes down, I have to sell assets to get that same level of income. Now, the other thing is that, the results, the return results that they assume in the programs. And they could seriously be overstated depending on the investment approach. It's quite often the investment approach being used is of, let's say, if you actually look at how the investments portfolios are being managed,
right?
It's active stock picking market timing, which we know historically you got 94% of professional managers failing to match market returns with large U.S. companies. And then, something like 97% of them failing to match market returns in the small cap market. And if you're assuming market returns,
right,
but the portfolio is being actively managed, or if there is market timing going on inside there.
By the participant, you mean?
Or by the investment
like a target
manager.
Date fund or so. Inside the
even
fund.
Target date funds. I mean, you look at target date funds. I remember Fidelity actually had their top holding in their target date fund is in 2007. Top holding was commodities. And it was the biggest holding in the portfolio. Why? Because commodities had a big run up. They added it in. Brilliant. And then all of a sudden commodities just nosedive. I mean, it was just like crash. And you go, wow, what an impact that has on a portfolio when they're engaging in that.
Yes.
And, you hear people say, well, I'm holding this investment portfolio and I'm going to let the manager figure out which stocks and when to get in, when to get out, what to do, in the portfolio. Or more likely, they don't even know it's happening.
Right.
But their assumption on the return of the portfolio is up here on what it's going to do in the calculator. The assumption being used for the calculator may be way up here, but the actuality may be way the heck down here. And where do we see that? We see the research from Dalbar and asset allocation funds. And we see that their rate of return is barely above the inflation rate on what investors have gotten in asset allocation portfolios.
Yeah, it would be interesting to know how these calculators, if there's any adjustment at all, because the other thing we see in 401ks a lot is we see, well, we're getting rid of these 3 funds and we're bringing in these 3 new funds.
Yeah, survivorship bias.
And generally, what I say to clients all the time. Do you think they're getting rid of the ones that did great or the ones that suck?
Right.
Like, okay.
Yeah.
And so do you think they replace...
Yeah, they're getting rid of the ones that stink, for the record,
Yeah.
okay? And
do you think they're
selling
replacing
low.
it with one that stinks or one that just really knocked it out of the park?
They're going to buy high. They're going to buy the thing that just did well, and they're going to get rid of the thing that did poorly. Yep.
And so
right.
even if they're using market returns, they're not, kind of to your point, they're not managing the ingredients the way to actually get market returns.
Right, exactly.
Yeah.
And they're...
I hadn't even thought about that, if the calculator would
investing.
change with a new fund or not. That'd be interesting to see.
Yeah. And, they're using what I have seen. They're using the funds that they've got, and they're using short-term past performance in telling you whether they're going to be any good. And then, the other thing I was thinking about was that they're assuming that you're going to be increasing spending forever. Now, this is the one that can actually play in your favor as an investor. And what I mean by that is that if we look at what people really do with money, I've talked about this many times, but it bears repeating. We look at what people actually do in retirement. They tend to spend lots of money in the early years doing all the stuff that they wanted to do forever, traveling to the places that they wanted to go to, spending time with the people that they want to spend, and maybe spoiling the grandkids or whatever, as you like to say.
Absolutely.
As you like to say, right?
That's the black hole in a retirement plan is grandkids.
But here's what people do in their 60s. And they're spending.
Yeah.
They're going places. They're doing things. They're going on cruises. They're, hanging out and having good time with friends and things like that. And then they get into their 70s and they start to slow down a little bit. So you got the go-go years, as we call them.
Mm-hmm.
And then you got the slow-go years. And the slow-go years is where I'm just starting to, I've been there. I've done that. I've done that trip over here. I've done that cruise. I don't want to go again. I don't need to go again. And it's ever so subtle that you tend to slow down. And then there's the no-go years, which is later on. You get into your 80s and you're just like, okay, I really don't have the energy to do anything. I don't feel like doing anything. And it's not necessarily terrible. It's just you don't want to do it.
Yeah, you've seen the Grand Canyon. I've done this, done that. Now, I have to share a personal story on the no-go years.
Okay, yeah.
About 10 minutes before we started.
Uh-huh.
I got a text from my stepsister.
Okay.
And so my dad, who is 91, and his wife, who is also 91,
wow,
just went to Buc-ee's for the first time.
Yeah.
So they just went to Buc-ee's for the first time.
Well, they beat me
so
there.
They're driving somewhere. I don't know where.
They beat me there.
They're at least not no-going. But
all right.
But yeah, it's just, that's probably the high point of the day, though,
that's
is
funny.
Buc-ee's not flying to France, or something like that.
That's funny. Well, tell me, I'd love to hear their experience on that one. I heard is it a big place? Isn't it a big place?
Oh, it's really cool. I mean, it's like a lot of cultural phenomenon.
Uh-huh.
You either love it or you hate it,
or
kind of a thing.
Your thing, huh?
But I'm an enormous fan of Buc-ee's, mainly because it's an Aggie that founded it. But just it's very well run organization.
Yeah. So we look at the Smile retirement, and what are the implications of that? Well, the implications of that are that, hey, maybe I ought to have a bunch of money. I have this money accumulated for retirement, let's say. And maybe what I do with this bunch of money is I bifurcate it, or I separate it up into a couple different points, or a couple different pieces. And I have some of my money that would be spent down. And we've done this in financial plans. In the software, we'll typically do this, the financial planning software, where we might have somebody that says, okay, this is my budget. This is what I want to spend. But, in my first 5 years, they might say, or first 10 years or whatever, they'll come up with a number of retirement. I want to spend another extra $10,000 or $20,000 a year or something like that.
Yep.
You do that too?
Absolutely.
Yeah. So you might have a certain amount that you want to spend. Let's just to put a number on it. Let's say that your number is $70,000. Just use have something to work with. So let's say that's your baseline. That's what you want to have for your retirement. Well, a smile in retirement basically says that maybe in the first year you're going to spend 90, and the next year it's going to be 88, and then you're going to drop down a little bit, and you're going to inflation adjust all this stuff. But you're going to be spending at a higher level in those first years to do all the travel that you wanted to do. And then you get that out of your system. Now you're going to get back down to the 70, and that's the sustainable amount. Well, how do we do that? Well, it may be that I have an extra bucket of money over there that I have, and let's say that the number in the first year of retirement is 90, I take 20,000 out of. I got my 70s, my base, and I got 20 over here, and then I spend that down, and then at that point, I'm like, been there, done that, got the T-shirt, I'm good.
Yeah.
And, that's one way of actually handling that. So do this. So let's take a quick break, and we're going to come back right after this and talk a little bit more about, because I want to get into Social Security, implications for Social Security, and when to take it and how to take it, and just some of the things to think about regarding that. And there's no hard and fast rules. You're not going to get out of Evan or I that you always take it early, you always take it late, you always take it at any point in time, because it really depends. We'll give you some criteria to just think about regarding this right after this. You're listening to the Investor Coaching Show. I'm Paul Winkler. He's Evan Barnard. We will be right back after this. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement. Real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. All right, we're back here on the Investor Coaching Show. I'm Paul Winkler. He's Evan Barnard. We're talking money and investing, and just going through, just the implications of, I just saw this guy doing a video on taking all of his life experience and trying to put it into a short video. And I thought, well, you can't quite shorten it up. You can't shorten this stuff up at all. I mean, we're looking at, how many years for you to get through your CFP, Evan? How long did it take you? Yeah, certified financial planner.
It took me a year to get my CFP, but I mean,
you went that fast?
Yeah, but I had been in the business probably 10 years before.
So you had a lot of experience already.
Frankly, I kind of poo-pooed the designation for several years.
Oh, did you?
And finally, it's like, okay, I'll do this kind of to see if I could do it. And yeah, I probably finished in about 8 or 9 months.
Wow.
The hardest, frankly, the hardest part for me.
Everybody makes that out to be, such a difficult designation, and I think that's a starting point. And there's so much you learned.
If you were brand new,
I was going to say there's so much you learned from actually doing planning.
Yeah.
So
the hardest part. Because at some point you took the Series 7 as well, correct?
I did Series 6, Series 63, Series 7.
Okay.
And then I got life health licenses and property and casualty licenses.
I never did property and casualty.
You never did property and casualty.
No.
That's auto and home insurance for those that don't know. Yeah.
But anyway,
yeah.
The hardest part for the CFP exam was following the curriculum answers that they want you to give.
They want you to give as opposed to what you really do.
Versus what's been happening for 10 years in my case of, well, that's not how the world works.
No, yeah.
And so I think that's why the test is so complicated or challenging is the entire exam is on the exceptions out there in the financial planning world.
Yeah, stuff you never see.
And so, your client has $18 million that's a former football player and they live in a community property state and they're getting divorced. You know, I mean,
now
like,
they started a company that got
people
stock
just
options
fall off
and
trees, you know. So frankly, that's what made it challenging, was trying to answer what I knew the exam wanted versus what I really wanted to say.
That's funny. Yeah, it is and you know, for me, that was a starting point. I did chartered financial consultant, which is, it's the same curriculum. You got the same classes. There are a couple others on risk management that are added on top of that. It's the same college that teaches the material, and somehow the CFP just got all the, you know, they did the best marketing job.
It's like the Marine Corps. We've got better PR.
Yeah, you better PR. That's right. Everybody knows who the CFP is. I went for CHFC, the Chartered Financial Consultant. And then, you know, I would collect designations on top of that. And, you know, the thing that I found helpful is getting into Social Security planning and then the wealth management stuff and retirement income certified professional. You know, so a lot of the different education programs out there, try to get all of that junk into 20 minutes in a presentation, everything you know about financial planning. You know, no, it's not going to happen. But I like the premise of what this guy was trying to do anyway. So then when we're talking about Social Security was another topic that came up. And the idea of when to take it, you know, if you take your Social Security benefit at age 62, recognize that the way Social Security is calculated, they're going to look at your average index monthly earnings. They're going to determine what your benefit is based on 35 years of data. Then if you take it at age 62, if your full retirement age is 67, if you're born 1960 and after, you know, you're basically looking at a 67 as your full retirement age. Now, what happens, you get a reduction for life of 30%. You know, so it's 20% for the first 3 years and then another 5% per year for each year earlier than that. So you're taking it 5 years early. So it's a 30% reduction in your benefit for life. And just to give you an idea of what that means, and then if you delay it, let me just say this before I go into these numbers. But if you delay it past your full retirement age, 67, you get an 8% increase per year, simple interest, for the next 3 years. So you'll have a 24%, 3 times 8% increase in your benefit from 67 to age 70, okay? So let's say that your full retirement age benefit's $2,000. Well, if you take it at age 62, that's $1,400. Your benefit drops down to $1,400. And, you know, you just take that and annualize that. Instead of a $24,000 income per year, now you're only looking at about $16,800. That's a pretty big difference in income, you know, and that's basically that's it. It doesn't pop back up later on. If you've taken it early, it's forever at that lower level. If you delay it to age 70, it's $2,480. So it's $2,480 per month, or that works out to just shy of $30,000 per year. So you go, okay, now difference between taking it at 62, $16,800 versus about $30,000, you're almost cutting your benefit in half. Think of it that way. But the other thing you want to think about is this, is your COLA, your cost of living allowance on your benefit. Your cost of living allowance is going to be based on that number or whatever it is your benefit was. So let's say that you have a 3% COLA, 3% increase because of inflation. If you took the benefit early, your increase over the course of a year, if your benefit goes up by 3%, is about $500. You get a $500 increase, but that person that waited to age 70, they have about a $900 increase due to the Social Security COLA. So not only do you have that permanently lowered benefit, but also your COLAs, your cost of living allowances, are a lot lower as well. Now, that doesn't mean necessarily that you don't ever take your benefit early. I mean, some of the examples, Evan, what might cause somebody to take the benefit early?
Yeah. Well, I mean, the easiest answer on that one is they need the money. I mean, if they can't keep the lights on, can't get all the groceries and pay for prescriptions.
That's right.
Then you've got to turn on the faucet if you have left the workforce.
You don't have enough savings, and you've got to have income.
And so that makes it a no-brainer. That's there's really not a decision at that point. It's survival. The other things I look at, you say to take it early,
Well,
right?
yeah, you take it
What's the
early. Now,
question?
look at health.
Is your longevity?
Yeah, very good. Yeah, go with that.
If I have a client, we were talking. It's probably been 3 or 4 weeks ago, that all the males in his family haven't made it past 74. And I mean, and he walks in and just, I'm living on borrowed time. Like, well, just in case you're not, let's keep planning.
Right.
But someone like that, I would encourage them to take it early, because whether you take it at 62, 67, full retirement age 70, those benefit lines cross around age 80.
That's right.
And so if you don't think you're going to even make it to 80, or if you're going to go, climb Mount Everest, if you're a parachutist, then I would encourage you to take it early.
Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.